Hey, it's Lisa Ryan, and welcome to the Manufacturers Network Podcast Live Edition. I'm here today with Per Sjofors, and Per is the founder of Sjofors, and he is the founder of Sjofors and Partners. Pricing has always been an interest area for Per. As a serial entrepreneur running companies in Europe and the US, he did pricing experiences. Now, some of these experiences worked spectacularly well, and others not so much. So as a result, Per founded his company out of his frustration that his business schools taught him about pricing is too abstract, too academic for a business executive to act on. So Per, welcome to the show today.
Thank you very much, Lisa, and thank you for having me.
Absolutely. So share with us a little bit about your background. What actually brought you here, and with this whole focus on pricing and the craziness that goes along with that?
Well, it's a little bit of what you just mentioned. And, I've been able to run a few companies here in the US and also in Europe before I moved here. And these experiments we did with pricing, some were spectacular. I mean, we could see revenues are up 25% the next quarter, and others were complete duds. And business school learnings were so academic and so theoretical that it was useless. So 13 years ago, I decided I was too old and too opinionated to report to anybody. So I decided to take that interest in pricing and develop a process that would make every pricing experiment a success. And that is the process that we've been using ever since. And the core of the process is to understand how you can predict sales volume at different prices. Now, once you can predict sales volume at different prices, and when you can predict revenue at different prices, you can obviously set the price that is the best for you, if that prediction is correct.
Right. So when it comes to manufacturing, I know you and I have talked about this a couple times, but we think that there's just one way to do pricing in manufacturing. It's cost plus. Yeah. But this is actually one of the biggest mistakes that manufacturers are making. And I guess there's two others. So what are you seeing about, these mistakes, and how can we start to turn that around and be more profitable?
Well, I think it's, cost plus obviously is and I've been there myself. In some of these companies, we use just rule of thumb, because different industries have different rule of thumbs. Some is 35%, some is 50%, some double the price, and in some industries you go up as high as 10 times cost. But it's all irrelevant, because your cost as a manufacturer has very little to do with the value you deliver to customers, So there's another thing that is kind of, well, if you think about it, is very logical, but a lot of manufacturers don't think about it. And this is, if you manage to reduce your cost, your price goes down in dollars, because it's normally a percent uplift, eh? So if you manage to reduce your cost, have your prices be where they are. There's no reason to just make a little bit more money. But another mistake, of course, is to simply look at a competitor. If you have competitors that have prices online, it's quote unquote easy. And many times in manufacturing, at least in my experience, you don't have that ability. You simply have to maybe try to get somebody's last year's price list, or maybe an international price list or something like that. And that give you some hints on where competition are pricing or set their prices, but it doesn't tell you the story. It doesn't tell you what deals they're making. It doesn't tell you what bundles they're making. It tells you what kickbacks they may offer to their clients, and special incentives and so forth. So trying to price on to a competitor just leads to just leads to the wrong price. And by the
Well,
way, that competitor may well have used guessing to set their price in the first place.
well, and you think about it, you're trying to differentiate yourself from your competitor anyway, as far as in terms of product, in terms of service, and in far of something else that you're doing. And if you're just going and pricing yourself the same, then what differentiating factor do you have?
Well, you used a very key word here, differentiators. And what this was key when I did these experiments was to figure out from the process I developed how you can differentiate yourself in ways that are meaningful to your customers, so that you can command higher prices, so that you gain a little bit of pricing power. Let me give you an example. We're currently working with a company that provides these steel plates that you run over when there's a trench in the street.
Okay.
Can you think about something that is more commoditized than a piece of metal?
Right, exactly. And it doesn't even have to look pretty. You're driving over it, for
Yeah,
goodness
exactly.
sake.
And so this company, naming no names here, they have managed to become, in their market, the high price leader. And they charge between 20 to 25% higher fees than competition. And they charge delivery fees, which competition doesn't do. Now, how do they do that? Well, by adding services to a commodity product. They have
Okay.
managed to position themselves to be the thought leader by providing educational services on safety,
Really
by having
interesting.
consultants that give advice on what kind of steel plates and other similar you should use. So it's they have simply managed to differentiate themselves that are meaningful to their clients.
And it probably, when you're selling that to a purchasing agent, they're thinking that they're just calling and buying pieces of metal to put on a road.
Yep.
But when this manufacturer comes and says, and we can do this, and we can share
Yep.
these safety tips and everything, it's just really looking at your business in a different way.
Exactly. Yeah. I mean, this is a trend that's been going on for a while. We know that, and that more and more sort of commodity manufacturers are turning into becoming service organizations that also sells the commodity, and by doing so, you almost always increase that pricing power.
Well, and one of the things that you mentioned when we had our conversation a couple weeks ago is if you do have that commodity product, maybe that's something that you have a little less flexibility in the price, or you said like bundles, making it difficult for people to compare
Yep.
those apples and oranges of the bundles. But then you're looking, if you're doing strictly a cost plus, then you have some of these higher margin things that maybe you're leaving money on the table. So
Yep.
tell us about both ends of that spectrum.
It's very interesting because companies that do use cost plus typically has the same uplift or margin for every product. But every company has certain products that are complete commodity and certain products that have a level of uniqueness. So one of the recommendations that we talk about is how to segment the products on a scale from unique to commodity. And what you want to do is that, I mean, you can categorize these any way you want, call them A, B, and C, meaning A are products that are completely unique, C are complete commodities, and B products are somewhere in between. Now, that then leads to a different pricing strategy for all of these. With the unique products, all discounting should stop, prices should increase. And for C products is all about relentless cost control, because true commodity products are being sold on price. And for those B products, those that are sort of in between, manufacturers should find out, can they make them into A products? Can they add something? that to make a product, a B product into an A product. So you gain that pricing power.
Okay. So, and you were talking about there's three mistakes that manufacturers make in their pricing. We talked about the competitor already, just taking a look at your competitor's pricing sheet and then making it up from there. So what else are they doing wrong?
Well, cost plus is a mistake. Again, because the cost has little to do with the benefit that your competitor does. And sorry, it's the benefit and the value that the customer sees. And in a like I said, in many competitive industries, the sort of cost among various manufacturers are kind of similar. So you end up having near identical product with near identical prices. But that is also an opportunity, because that means that the savvy manufacturer can differentiate themselves and sees, typically once they do, see a doubling of sales growth and 25 to 40% higher margins.
Right.
And that by itself leads to 25 to 40, 3 to 5 times higher valuation, which is huge,
Yeah.
And then of course we touched upon this already, that the third major mistake is simply to guess.
Right.
And I remember speaking to a CEO, this is a couple of years ago, and he had this product, and he said, "We priced this at $160. I don't know," he said. "Maybe it should have been 99. Maybe it should have been 350. I don't know. But 160 just felt right."
Right. It's so funny. We talk about this and immediately my mind goes to Shark Tank. You have people coming onto Shark Tank and they want a $10 million valuation.
Yes.
And the product hasn't even come to market yet. But then they say the sentence that the sharks hate. But this is a $3 billion business.
Oh, yeah.
And they're thinking, and if we just got 0.02% of that business, it could be, and drives the sharks wild.
Yep.
But I think that guessing comes from, well, it seems like a good idea, and this is the size of the market, so we should just guess our pricing to be that way.
Yeah. Well, there's another term for that, which is the Chinese sneaker syndrome. I'm going to sell sneakers to only 0.5% of Chinese population. I'm going to be $100 million company.
Yeah, exactly. Exactly.
But it's interesting also that that you mention Shark Tanks, because they talk about pricing there sometimes, but also the sharks are there and they're doing the same mistakes. They're saying price like your competitor, or price a little lower. I mean, your product is not as good as a competitor, so price a little lower. And how much is a little lower? Well, it's gut feel lower. Or your product is a little bit better, so it's gut feel higher. That's not the way to do it. That's guessing.
Right.
And it's so funny because companies in general goes from, everything should be driven by data. And then you guess the price.
Exactly.
So, so that's interesting. Yeah.
Well, and it's kind of like, too, asking your friends or asking people, hey, I'm about to develop this product. Is it something of interest to you? Oh, yeah, that sounds like a great idea.
Yeah.
That's the best idea I've ever heard. But
Yeah.
the follow-up be, would you buy it and what would you pay for it? And try to get that real sense of, yeah, that's a great idea. Because again, we go back to Shark Tank. How many of those people are, all my friends told me this was a great idea.
Yeah. Well, whenever you do some as a startup, if you ever, you never want to talk to your friends about this,
Right.
because they will never tell you the truth. I mean, you come up with a dud of a product or a product idea, and they will say, "Oh yes, this is great," but that's not. I mean, I think there's statistics out there that roughly 40% of all all startup fails because they say there's no product to market fit.
Mm.
And this is, of course, why? Because they haven't done the research, they haven't done they haven't understood what potential customers truly are willing to pay for that product. So they're guessing their price, which means that they're either too high and it won't sell anything, or they're too low and they're not making enough money.
Right.
And so they fail. And it's about that ability that could be done with extraordinary precision to understand sales volume at different prices, and that will always lead to the right price. And
And it,
sometimes if you do this as a startup, you may end up saying, I will never make money on this product, so just kill it right now.
right. And when it comes to pricing, again, a lot of people are thinking, well, it's got to be the low price. If I can just come out with the lowest price, then I can make it up in volume. So
Yep.
what's the error of that thinking?
Well, I mean, look at, this is obviously a very well-known example, but look at Apple versus Samsung. I mean, what Samsung have telephones or smartphones that are technically superior to Apple in virtually all aspects. Yet a Samsung phone, or most of them, are like $300, and an Apple phone is $1,200. How
Wow.
did they got there? Well, they got there by superior marketing, by having differentiators that make sense to the client. And yes, Apple have a small market share, but they have obviously superior valuation, and they generate 70-80% of the whole cell phone industry's profits.
Right. So if somebody listening or watching this podcast today, it starts decides that they need to start looking at their pricing, what's a good place for them to start?
Well, obviously, I want to put forward myself and
Of
my
course.
company. I mean, there's just very few people that work with pricing in the way that we do, and it's a unique way, and it's a practical way because it came from that very practical need I had in the companies I've been running. So obviously, my website is sjofors.com, sjofors.com, and my email is per@sjofors.com.
And so what does that process look like? So a client comes and you're going to start working on their pricing. Where do you start then with them?
Well, we actually start specifically with manufacturers. We start with what we call an impact analysis, which is a fairly short. We have our own AI software, but it's a fairly short term and not very expensive analysis of a company's transactional sales data. And from that, we can do an assessment of how much more would they make if they price right.
Mm.
And just to, this typically, the answer is say a typical 25, 50, $100 million manufacturer. The results of that is almost always several $1 million in revenue that are pure profits.
Wow.
So
Well,
it makes a big difference.
So if you could wrap it up in a nice bow and share your best idea or biggest aha somebody watching this today can take with them, what would that be?
Pricing. Well, pricing is much more important than most companies believe it is. And pricing is also something that you can work with proactively, and that it will, and pricing is part of the 4 Ps of marketing for a reason, because all of those 4 Ps are connected. And when you start working with pricing proactively, the company will earn superior profits, it will crush competition, and it will lead to unexpected shareholder values.
Well, Per, it has been an absolute pleasure having you on the show today. Thanks for hanging out with me here.
Thank you very much, Lisa, and thank you for having me.
You're welcome. I'm Lisa Ryan, and this is the Manufacturers Network podcast. See you next time.